Good evening, everyone. Thank you for joining us this afternoon for the webinar Investing 101. Today's webinar is hosted by the Maryland Smith Young Alumni Council and the Robert H. Smith School of Business Office of Alumni Relations. My name is Mark Forrest, and I am the Program Director of Alumni Relations for the Robert H. Smith School of Business. Please note, this webinar is being recorded and will be captioned. Please mute your audio line during the conversation. If you have questions, we encourage you to use the chat feature to enter any questions or comments you may have for the presenters. And with that, I will introduce our moderator for the evening. Zadia Moastili is a Maryland Smith undergrad alumna of the class of 2015 and a member of the Young Alumni Council. Since her time at Smith, Zadia has grown in her career at PepsiCo. For 3 years, she used her supply chain degree as a Pepsi Beverages frontline manager, covering the Baltimore, Washington area. Then, leveraging her marketing degree and her master's in strategic public relations from George Washington University, Zadia transitioned to PepsiCo's DC Office of Public Policy and Government Affairs, where she co-leads communications and heads Sub-Saharan African engagement. This fall, Zadia will be beginning her MBA at the University of Pennsylvania's Wharton School. Like many who may be here tonight, Zadia is new to investing and excited to lead and learn from this conversation. Please welcome Zadia, who will introduce our featured speakers for this evening.
Thank you, Mark, for that introduction. As Mark mentioned, I'm new to investing and looking forward not only to guiding us through this evening's discussion, but also learning from our speakers and their wealth of knowledge. So with that, let's meet our speakers. First, I'll introduce Melford G. Brown Jr., or Mel Brown, who's a financial advisor, chartered life underwriter, and chartered financial consultant professional with 26 years of experience. His firm, MG Brown & Associates, a financial advisory practice of Ameriprise Financial LLC, is located in Towson, Maryland, provides comprehensive financial planning services for individuals, families, and small businesses. Mel, thank you so much for being here this evening.
Thank you.
Next, I'll introduce Mike Gabor. After earning a degree in finance from the University of Maryland Robert H. Smith School of Business, Michael Gabor began as an investment banker for Lehman Brothers at 14 Wall Street in New York City. He continued in the industry working at Dean Witter and A.G. Edwards and has over 25 years of experience in the financial services sector. Mike is currently the CEO of Vivix Capital, a quant-based fund that takes advantage of volatility in the stock markets. He is also a co-founder in ArcLight Development Group, which is currently developing and building a 20-story condominium building in St. Petersburg, Florida. Mike founded Vant Trading and is working with his 2 sons who also attend the University of Maryland, teaching new traders how to be successful in trading in the markets. Thank you, Mike, for being here this evening.
Thank you, Zadia. Appreciate it.
And finally, I'll introduce Denny Goforth. Like many financial advisors, Denny Goforth aims to help simplify and improve his clients' lives. Currently, Denny is the Senior Vice President of Wealth Management and Wealth Advisors at UBS Financial Services. He is also a member of the Financial Planning Association and the Investment Management Consultants Association. While it is Denny's clear and objective financial advice that helps his clients turn their personal successes into comfortable retirements, Denny defines success by his ability to help his clients pursue their lifelong passions. Above all, Denny seeks distinction and balance in his life, constantly striving to be the best father, husband, friend, and advisor that he can be. Thank you, Denny, for being here this evening. So with that, we'll give these 3 Smith terms a warm virtual welcome. And of course, we don't have much time this evening, so we'll start with the basics. What are some concepts new investors should consider before jumping into investing? And I'll go ahead and start with Denny. If everyone can be able to unmute themselves.
Sorry,
speakers.
I'm good now.
Okay, got it. Thank you, Denny.
Still do this Zoom thing 15 months later, so
no problem.
Pardon me. But as we were talking in the pre-call, investing is really not something that anyone should jump into. But having said that, I believe there's a lot of risk in overthinking or overanalyzing things and being paralyzed into non-action. for most of the callers on this call at this point in your lives, doing something, doing anything is going to be a lot more important than specifically what you're doing at the time. And throughout the night, you'll hear me draw a lot of parallels between the concepts of investing and planning and physical training. I think there's a significant number of parallels between that. And so if you're someone who's never exercised a day in your life, right, you're not going to go out there and run an Ironman triathlon as your first race without proper training, without understanding what you're getting into. Having said that, you're also not going to only read about Ironman triathlons or talk to everyone about Ironman triathlons, right? At some point, you need to execute. At some point, you need to get moving. And so I think for a lot of people who are new to investing, the best thing to do is to start moving in some way. Start simple, start basic. Don't worry about what supplements to take or what exercises to do. Those things will come later. In terms of concepts that I think everyone should have at least a basic understanding of or working knowledge of prior to jumping into investing. And these are terms that I use a lot in my practice. Comprehensive financial planning. We all talked about this. Investing is a subset of comprehensive financial planning, right? You can't invest until you know what you're investing for. And so part of that is setting goals, trying to quantify those goals, the whens, the how muches, the wheres, thinking about a time horizon for your various objectives. That has a lot to do with and is going to be a significant driver of how you invest your money. How long of time do you have? Is it retirement that may be 30 or 40 years away? Is it down payment on a new house that might happen in 18 months? Big difference between the two. So time horizon is important. Budgeting, making sure you're spending and living within your means, I think is wildly important. Understanding and getting a definition of risk, right? Risk means different things to different people. Sometimes it may be the permanent loss of capital. Other times it might be your inability to earn an income, but understand what risk is and what your tolerance for risk is. The concept that you hear me talk about all over and over again is asset allocation, right? None of these concepts are things you're going to talk about at a cocktail party, right? You're not going to hear these come up. They're not exciting. They're not sexy concepts, but they're really fundamental and they're basic building blocks to the planning and investing process. So how much money do you have in the various asset classes? That's responsible for 92% of your return. So let's make sure we think about that and get that right. And then the other concepts that you'll hear, diversification, dollar cost averaging into investment strategies, and then the power of compound interest over time. So those are kind of the concepts that I would get my arms around before I considered what to invest in or how to invest.
Got it. Thank you so much, Denny. Mel, Mike, do you guys, either of you have some additional concepts that new investors should consider before jumping into investing?
Yeah, I mean, Mel, you want to step in first?
Well, it goes back to the athletic concept. It's like if Denny said, if you're planning to start getting a fitness program, your very first building block is finding out what kind of health you're in before you do it. So, you know, I always say visit a physician first. So financial planning is that basic medical or examination of yourself. And you need to know what you can and cannot do as part of how you're going to get to your goals. So, I mean, and a lot of this, investing, again, is a subset of financial planning, but it really comes down to starting and getting a basic understanding of who you are, what you're working with, what obstacles you may have in your way, and getting more comfortable with the notion. So, I mean, that's a foundational issue that I think is core to any plan going forward, regardless of financial or anything else you're doing.
Yeah, and the only thing I really would add to what Denny and Mel said is start with education, okay? Educate yourself on what's out there. I completely agree. You got to know who you are. You know, for people that we hire at our fund, you know, I recommend you have a life plan, not just a financial plan, but a life plan. Okay. I mean, we don't hire anybody that cannot show us their life plan. If they haven't done one and we really like them, we make them sit down and do one. We advise them how to do that because it's really important to, like you said, know who you are, know where you're going. I got an interesting perspective. I think Denny and Mel appreciate this. So I started a side company, which was doing continuing education for Series 7, life and health, individuals and stuff like that. And, we would go in and do these continuing education credits. And most people, when you go there, you kind of sit there and people don't follow it. They just read the paper, stuff like that. But we would talk about it where, only 17% of the people actually use a financial advisor. Okay. 17%. Okay. 73% of the people who get financial plans don't follow it. Okay. And we used to talk about, what good is a financial plan if you don't follow? And I'm sure Danny and Mel would agree. It's one thing to put all the work together and put a plan together, but to follow it. So what it really comes down to is understanding yourself and understand what you're going after. And most people think when they set goals, it's all about the money. Well, what we found is to really get somebody to follow their plan and get you to follow your plan. It's not about the money. It's about the why. Okay. It's why do you want that money? What's that money going to get you? And so expanding out your goals, not just saying, oh, I want to make, $5,000 a month investing. And, if somebody looks at that plan and says, okay, they look at that plan and say, all right, well, I have to actually cut back. I can't have my Starbucks. Dandy told me that I have to actually, not go out on bars on the weekend, stuff like that. They're not going to follow it. But if they look at that plan and say, you know what, this is going to enable me to be able to, retire early and walk on the beach or actually buy a bar that I want to own or whatever is that goal, that's the key. So, doing a life plan, understanding where you're going. And I completely agree with what they said is you just start now. I mean, start somewhere, get yourself a mentor. Okay. You got two really good ones here. Get yourself a mentor, somebody that's going to guide you through the process.
Yeah, thank you all for that insight. We've talked about where we are now and setting those goals. So, for me specifically, and I'm sure as many others who are tuning in, are recent graduates. So let's talk about managing existing debts and the risks associated with investing at this point. I'll direct this question back to you, Mike. What are some ways to go about managing financial obligations such as student loans? And how does a new investor balance that with investing?
That's a very good question. The question about debt, there's good debt versus bad debt. So the first advice I'd give you is don't incur any bad debt, please. It's very easy to accumulate debt. Student loans, I would consider good debt. And the key is when you're analyzing your debt, it's whether what you're trying to do is decide where you're going to allocate your money, right? And so I would absolutely allocate, no matter what you have as far as debt, to start at least taking a portion of that money that you're bringing in and start investing that money. And one of the keys that we do is we'll take a look at, okay, when somebody has debt like your student loans, typically it's a low interest debt, okay? And if the cost, so you got to look at the cost of what that debt is versus the possible returns of where you're going to invest that money. And the key for us is, understand this: successful people separate themselves from unsuccessful people in two ways to me. Okay. Number one is successful people have their money work for them rather than them being the major asset for producing income, right? That's the way the majority, look, it's the old, I think it's the Plato principle. It's the 80-20 principle, right? Why is, 20% of the people out there, financially able to retire when they get to the age of 65, right? It's because, they do what other people typically don't do. And so the key is, you got to start and, you got to create and have your money work for you as early as possible. And what successful people do is they create several different lines of income. Like even us as the funds, I mean, we don't have just one line of income coming in. We have several different lines, and we teach our traders to do the same thing. And a lot of personal traders, what we teach them is, have 4 or 5 different lines of income coming in where your money's working for you. Maybe go into real estate, maybe go into investing in stocks. Again, the more you have your money working for you, the best. And the other thing that successful people do that really unsuccessful people don't is they look at risk first. They always look at what the risk is. They don't get seduced by returns. Okay. And in today's marketplace, it's so easy with Twitter, online, you got Facebook, social media, everybody says that they've got into AMC today at 20 and got out at 70. Okay. I can guarantee you 90% of those people did not do that. Okay. So don't get caught up in that. Risk first, look at what is the risk of a particular investment? What is your risk profile? Okay. When I was a young buck, I used to tell everybody, look, you got to be in stocks, man. You got to be in stocks. You should be investing in stocks. You got to do this, right? The stock market over the long run, you're going to make all this money. And then I realized, when I was actually dealing with some clients that, no, everybody shouldn't be in stocks because you got to understand what a person's risk profile is. And to me, a risk profile is, what does it take for you to be able to sleep at night? Okay, because there's an investment for you, as Denny and Mel will go through. There's plenty of different types of financial products out there. Okay, understanding yourself and what your risk profile is the very first thing. But you got to understand too, there's this basic law of risk to reward. Okay, you can't expect to have no risk and then expect, somebody to help you deliver, 15, 20% a year in returns.
Yeah.
Okay. So, that's what I would say about that.
Gotcha. And I'd like to open the question up to Mel and Denny as well, but I would like to add to that. So how does a new investor know how to balance, student loans, existing debt with investing? And then can you define the different types of investing as it relates to your respective industries?
Okay, I guess I'll go first. I think the first thing I'll always fall back to my original premise about knowing who you are, and not only, I mean financially as well, because the only way you're going to make progress is you have to have a full understanding of how your money comes in and what you're doing with it. As far as addressing debt, consumer debt, and let's define what that means. I mean, student loans is one kind of debt, but I consider that an investment because it puts you through college and puts you on the path to building your career. Credit card debt, things like that, unsecured loans is what we consider the bad debt, especially when it gets into higher interest rates. And if you are prone to doing that, to me, that's a sign that it comes to basic cash management, because if your cash flow is not positive, then you're going to have to make up the difference with the debt. So, a lot of times I've talked to people who think they have positive cash flows and can save because they want to. But then when you look at the reality of their finances, they don't have a lot of cash close by. And by that, I mean checking account, bank, savings account balances. They've got credit card balances, which to me is a sign they actually have negative cash flow. That you got to fix first, because if you can't do that, you can't sustain any kind of long-term investing or wealth building. What does that mean? That basically means you need to do a very candid analysis of how you make your money and how you spend it to get a sense of, do you have the resources to build wealth? Because that's the building block for all successful planning. And honestly, it's one of the more overlooked pieces of financial planning because it protects everything else.
Got it. Thank you. We actually did have a question come in regarding this point. Do any of you recommend paying off mortgage debt in today's world, or use that money to invest somewhere else? If anyone has an answer, go ahead, Denny. You're muted. Yep.
Okay. I'll give an answer. Mortgage debt is secured. It's very low interest, and it's for a long period of time. One of the things that I think people don't understand about houses is they can be very cash intensive. You think about the trips to the Lowe's, the Targets, the maintenance on a house. If you have the opportunity to speed up a mortgage or build cash, I suggest you build the cash, because you're going to need that liquidity to protect liquidity, to deal with the surprises that may come your way that you might foresee and some that you don't. And you're going to need to be able to deal with it quickly. And if something comes up and you're busy trying to accelerate a mortgage and you need, $5,000 or $10,000, you can't tear up a piece of the floor and cash it in. So, good liquidity to balance that out always, I think, comes in handy. And that's the kind of rubber meets the road thing that a lot of people overlook, and is at the heart of what I think is behind most of the angst that people go through in their finances, because they'll try to make the big kill with the long-term investments and leave themselves vulnerable to surprises that we call life.
Got it. Danny, I see that you are now off mute. Did you have something to add to this? No problem.
It wouldn't allow me to unmute myself, but now I fixed it. So yeah, I mean, the debt question, the mortgage question, they're all part of the same question that we get over and over again in my business. And that is, you've got money, you've got debt. Do you use that money to pay off the debt, or do you invest that money? And I think you got to calculate, number one, what's the interest rate on the debt, whether it's student loans or mortgage. If you're paying 2 or something that starts with a 2 or something that starts with a 3, and in a lot of cases, the interest on that is deductible, which means the actual cost of borrowing is significantly lower, and your expected rate of return on whatever your investment portfolio is 5 or 6, then it doesn't take a rocket scientist to figure out that, hey, 5 or 6 is better than 2 or 3. And so over time, it's going to make a lot more sense to not pay off that debt. And to piggyback on what Mel said, if you decide to pay off your mortgage, you're sinking money into your house. And I don't want to make it sound like it's a bad investment, but that money's gone until you either sell the property, refinance, borrow it back out. And none of those things are very easy to do. And so for me, I'd rather have the debt knowing I could pay that off at any point in the future with the liquidity of my investments, but I can't do the opposite, right? I can't go into the house and pull up a floorboard and turn it into $5,000. So that's an important distinction. And then I think you've got to, we tend to be very objective in this business where it's black and white, what makes sense from an economic perspective, but you also have to take into account, especially when dealing with individual clients, the psychological and emotional impact. If you're someone that is scared to death of debt and you have this mindset of, I don't want any debt at any time, then it doesn't matter what the right thing to do is financially, right? It doesn't matter because you need to be paying off your debt as quickly as possible. And so take your feelings, your emotions in this into account as well. And sometimes those, not necessarily the right decisions, but sometimes those drive our decisions in terms of debt.
Got it. Thank you so much for all that insight. So let me kind of switch to a different question now. Someone like me, I don't yet have a mortgage, but I do have student debt, so equally paying that off, but I do want to get into investing. So what would you suggest is the best way for a beginner to start investing? And are there any key resources where they should start to learn about investing other than just going to a financial advisor, of course, and getting your expertise? But I would love to hear from each of you in regards to what you think on that.
I'll start here and then mute myself. But at least me, my practice, my firm, we have a tremendous amount of resources that are built specifically for this client segment. It's one of our client segments that we focus on a lot. And hopefully Mark will have the opportunity to send out all those resources to everyone on the call afterwards. But short of that, number one, and I think we'll all agree on this, is engaging with a financial advisor. And I think, if you're just graduating, you may think, well, I don't have enough money, my situation's not complicated enough to hire an advisor. And I say that's not true. There's someone out there that can work with you. And, a resource that I use there's a website called plannersearch.org, and they will put you in touch with any number of certified financial planners in the area based on the criteria you put in. So there's someone out there for you. If there isn't anyone, certainly a family member or a friend that is an advisor, although you've got to be careful there because it's tough to take advice from friends or family members. Their goals might not be aligned with yours, but I think it's a good place to start. Another thing we talked about in the pre-call was if you have access to a retirement plan through your employer, and I'm hoping that most of you do, that retirement plan has a significant amount of resources that are often underutilized. And so the plan provider itself, whether it's Vanguard or T. Rowe Price, whoever the provider is, has a ton of resources built into their website. And most plans have an advisor attached to them as well, where they can help you out and offer you advice, maybe not on the specific investments in the plan, but on things you're doing outside of that. So utilize that as a resource. I know we have online financial courses for this generation. I looked up before, Coursera has an online introduction to personal finance. I think that's a great place to start. That actually it's produced by the same company that we partner with for our online courses. I used to give out a book to every either young investor or new intern that I hired. It's called the Wall Street Journal Guide to Money and Investing. It's out of print. It's been out of print for like a decade now. So it's a little bit dated, but it's a really easy book to read. It's got a lot of pictures, and it really starts from the basics of everything you need to know about money investing. And I still recommend a book like that if you're into books. I think a PDF is available online as well. And then I use websites, objective third-party websites like Morningstar.com a lot in my practice. And I think they're a great resource for individual investors to get unbiased, objective advice on which specific investments to be in. So that's my list.
Great. Thank you so much. Mel, Mike, do you have any additions to that list?
Well, I think if you look at the timing and where we are already, we're halfway through the time we have. So
Sure.
just to make it clear, we're not going to knock all of this out for anybody in this one session. Okay. I do think, though, that especially for people who are working, who are employed by somebody, one of the premises we go on when we do financial planning is the vast majority of it can take place through your workplace. I mean, it makes sense. That's where you make your money. That's where most of your benefits are, most if not all. That's where your retirement plans will be. So you can do a lot of this through utilizing the workplace. You just start small, but you do need to start something. And I think one of the big mantras, we're big on mantras in this industry. And they always say the more money is lost to indecision than bad decision. We've been in this business long enough to know that that is absolutely true. And if you talk to a financial professional, don't think that you don't qualify to talk. I mean, I've always believed, and I know a lot of my colleagues operate this way, that we know that we can be impactful in people's lives, the whole process. And I feel like we've signed a Hippocratic oath, much like a doctor. So if you can help, you should. And there are plenty of qualified professionals that are trying to help people walk away feeling better than when they started the conversation. So feel free to reach out to people. It doesn't have to be us, but it could be anybody. But yes, you should. And if you're in over your head or you feel like you are, ask a professional. And it's their moral obligation to help you.
Yeah, and guys, girls, if you're in college now, we have so many people coming to us that are in college now, asking us to help them. We're not financial advisors. We don't charge anything. We don't have products and stuff like that. We have and you'll get it in the packet. We have a YouTube channel that we just started because we have a lot of people that came to us and asked us how to trade and how to invest and stuff like that. My biggest thing is look, I've been on all sides of this industry, inside and out, from the advisor side, from the fund side, from the investment banking side. Okay. It doesn't matter. Get yourself first a mentor, but also start, man. Just start. There's so many kids in college now that have opened up trading accounts. Access to the markets, access to financial education has never been greater. We have a 20 series class that we put together on how to trade the markets, and it's probably a $10,000 class. And the key is to put yourself in a position through education. I mean, you're in school now. Educate yourself. Start fooling around with some stuff, that's the only way you're going to do it is by sticking your toe into the water. And trust me, you're going to be really, you're going to love it. The fact that you've done some education on this while you can now. Okay, because it's so important that you have the time. I mean, your life is all about the series of choices you make. Okay, and you can either go out and party, or you can actually take some time and start, investing in yourself. And I'm not talking about school. I'm talking about, hard-nosed education. We got a list of about 20 books that we recommend to people, and you'll be surprised that, really it's all about the mindset and who you are. Okay. And, the reason it's so important about who you are is because, we always say it, people don't trade the markets, they trade their beliefs about the market. People don't, and their investments, what they do with their money is typically framed in what their beliefs are about money. You could have a Mel, you can have a Denny tell you all day long what to do. But if you have this belief about money that, it's to be spent or it's to be this or that, you got to analyze what your beliefs are about money now. Okay. Because most of you, where you got your beliefs about money came from either your parents, who maybe weren't good at investing money, or came from some outside source which isn't feeding you properly. So just make sure you really take into what you're allowing into your mindset and examining what your beliefs are about the markets and money.
Got it. Thank you. I'm going to turn the next question over to Denny. I know that you mentioned this in your previous points, but can you explain all types of retirement savings and how you can invest through retirement savings? So 401k, IRA, HSA, etc., and then how those grow over time. I'm not sure if that's detailed on some of the websites that you listed, such as plannersearch.org, I believe it was, but would love to just get your point of view on that, on all those types of things, if you can unmute yourself. Oh, no. Okay. Mark, if that's a possibility, then that'd be great.
Sorry. There we go.
Okay. I believe you
Good.
can now. Great.
Great.
Thanks.
Sorry about that. I'm for whatever reason, I'm not able to unmute myself. So it's a great question, and I think we alluded to it in previous comments. I think it often gets overlooked, right? We're all worried about investing and what we're going to do on our own. As Mel said, I think the majority, if not all of your investing, at least when you're young, should probably occur through the workplace. It can be and should be your primary means of investing, especially when you're young. So most retirement plans have great online resources. They've spent a lot of money to build these things out. Your employer is paying a lot of money for access to these resources. And oftentimes they come with an advisor. So please take advantage of that relationship if you haven't already. Essentially, the way retirement plans work, they all work almost the same way. If you work for a private company, or you will be working for a private company, you hopefully have access to a 401k plan. If you work for a nonprofit, it's going to be called a 403b. If you work for the government, it's going to be called a thrift savings plan, a TSP. And some smaller employers, some mom and pop shops might have a SEP IRA or a simple IRA set up. But essentially, they all work the same way. In each of those plans, you're allowed to defer a certain amount of money. It's usually expressed as a percentage of your compensation, so 5%, 10%, into the retirement plan. And you can do that on either or both a pre-tax and or a post-tax basis. So pre-tax means it's going to reduce your taxable income today. If your income is $100,000 and you defer $10,000 into the 401k plan on a pre-tax basis, your taxable income is down $90,000. So it reduces your taxable income up front, grows tax deferred. It's taxable when you take it out. Post-tax money doesn't reduce your taxable income at all. That $100,000 of income is still $100,000 of income. Money goes in, but it grows not just tax deferred, it grows tax free. So you have the option of choosing one or both of those. That's a decision. That's the second decision we usually make with retirement plans. I'm happy to help anyone offline on that. And then if you're fortunate enough, your employer is going to provide some type of contribution at the employer level. It's usually expressed as a matching contribution. So they'll say, we'll match dollar for dollar up to the first 5% that you put in, which means you want to put in at least 5%. Otherwise, you're leaving free money on the table. If you put in more than 5%, you're certainly welcome to, and it's a good idea to, but you're not going to get a higher match. Those funds into your own account, and then you have a menu of investment options to choose amongst to invest those funds according to your goals and objectives. They're designed for retirement, so you shouldn't be putting money into a retirement plan that you are going to need next year, although there are ways to get it out of there or borrow against it in a crunch, but we don't want to anticipate that. And then they either come out tax-free or taxable depending on how they went in. It's like crossing over a bridge. You either pay the toll before you cross the bridge, or if you're going the other direction, you pay the toll after you cross over the bridge. But the real benefit here is tax deferred or tax advantage growth, whether it's tax deferred or tax free. that's something you cannot replicate on your own, right? You can invest all the money in the world on your own, but you're never going to have the advantage of the tax advantage growth that the 401k or your retirement plan provides. So take advantage of it. The possible matching contribution from an employer, again, not a major driver, but certainly an incentive to contribute, and certainly money you shouldn't leave on the table. And then the way retirement plans are set up, you're contributing a dollar amount every pay period, or a percentage every pay period. And that is the absolute definition of dollar cost averaging. So you're putting in a fixed dollar amount into a investment strategy every single pay period, whether the market goes up, down, or sideways. And that's usually a great way to average into any investment strategy. And the nature of a 401k is that you're going to do that on its own. So you don't have to think about, when should I invest this money? It's going to happen automatically. You pay yourself first. So those are the benefits of a retirement plan. I would encourage anyone who has access to one to take full advantage of it before you start thinking about investing money on your own.
Great. Thank you so much, Denny. Mel, I'm going to direct the next question to you. So we've talked about what we can do through our employers, but in regards to like what we can do by ourselves and the stock market, I think that's why a lot of people are tuning in this evening. One question is, how can an investor anticipate smart investments versus buying during or after a market boom? I know we mentioned AMC or GameStop and some other things that have happened this year, but if you could just touch on that, that'd be great.
Oh, I don't know that I would touch on that, because you know, we all introduced ourselves to you as financial planners, and that what you're seeing in the papers right now is more about trading and trying to, and I actually believe it more is gambling behavior than anything else, masquerading as investing. So if you go by what Denny just described and how you would put money away and build wealth over time, you would be putting money in a plan, whether it's through a 401k or systematically investing somewhere else, day in, pay period in. So you don't even have to worry about where the news cycle is going, because it's going to happen with or without you anyway. So the money gets put away for you over time. And, you know, the concept I use is the tortoise or the hare. We've been doing this a long time. The tortoise usually wins because they're consistently in that market. In fact, one of the other mantras we're good for is time in the market is more important than timing the market. And right now, I think because we're coming out of the pandemic, there are some unique conditions here. We're coming out of the pandemic. People are flush with cash because they haven't had a chance to spend it, and they want to try to catch up to the people who they see on TV, who are the, you know, the big entrepreneurs and everything else. But fundamental financial planning, fundamental investment strategy is generally how most people build wealth over time. And if you can do that, it actually liberates you from watching the news cycle, because you're going to be constantly putting money away on a consistent basis, whether things are going well or not going well. I mean, one of the great questions we like to throw people in a presentation is you ask them, well, how many recessions has the US economy gone through, say, in the last 60 years? And they will say, you know, 3, 4, maybe 5, when the truth of the matter is 10 and maybe now 11 with this recent pandemic. And that's gone on. You know, I've lived long enough to see presidents on both sides of the aisles, wars all over the planet, pandemics, tsunamis, earthquakes, everything else. Consistency gets you through all of that. So I'm not a big proponent of jumping in and out of the markets, which seems to be in vogue now. Consistency, you know, putting away a little of what you make and living on the remainder always works. It's a key to the way Warren Buffett builds wealth, or how he tells everybody else. I don't think anything like that has changed. So it's not to dodge the question, but based on how we approach building wealth, it isn't married to the news cycle at all, if that helps.
Gotcha. That does help. And I know personally, I'm more risk averse, and I appreciate the tortoise or terps, shall I say, method of going about things. So really do appreciate that.
Well, that's a Maryland thing, because you're a terp. I mean,
exactly. Exactly. Mike, I'm going to direct that over to you and kind of add on to that, because I know you can speak specifically to investing in alternative investing opportunities such as cryptocurrencies. I know that language is being tossed around a lot as well. So if you could speak on that, and also just kind of going with the market or not, and et cetera.
Yeah. Look, I mean, investing has changed so rapidly over the last, 10 years that it's, it's just astonishing how it has changed. For the majority of the people, it's all what you want, guys. Okay. For the majority of the people, if you want to work at a job, you want to, have the picket fence and, you want to invest that money through your company, you can do that. Just be careful. Okay. Because I can give you example after example, my dad invested, through his 401k. Now the rules have changed, obviously, but it all went into Lucent Technologies. And he had $1 million portfolio, and then next thing you know, Lucent Technologies was bankrupt, and that whole portfolio was gone. Right. So, the majority of the people should really just, stick with an index fund, go to a financial planner, just, do your dollar cost averaging. That's what you need to do. And that's not the type of people that we talk to, right? We're dealing with people that are looking to create those other lines of income that's going to produce that ATM machine that's going to, be producing. Because, we can spend all day about how investing has changed with, exchange traded funds and with the way the algos have stepped in and the way cryptocurrencies have popped up. The key is, again, I know a lot of people, we get it. We have so many people asking us about trading in the markets right now. I hinder that talk, right? Because I think it's positive talk. I think, the days of, managed money, people just scooping money up, putting in managed money, earning their 5% a year and stuff like that. You can do that, but people are now smarter. There are people out there that realize that they can really amp up their returns and really create a line of income and several different lines of income just by making a couple tweaks, taking some education, and not getting hammered by fees and getting hammered by hidden fees and stuff like that. And so you have a lot of people now that are dipping their toes in the market. And to be honest with you, people should not be doing that. Like, I always give caution, because I'll give you some statistics. 90% of the people that think they're going to day trade and try to trade lose money. Okay. Mm-hmm. So now you might say, Mike, wait a minute, you just told me, yeah, it's exciting that people are getting into the markets and stuff like that. Yeah. What we focus on is what the 10% do, right? And it's kind of very similar to what Denny and Mel do. I mean, of the 10% people that are successful at day trading, 95% of them have a written trading plan down. Okay. They do that, and we can go on and on. It's all about mindset. It's all about this, right? But the key is, for most people, especially people that we're talking about here, is, it's your risk profile. Like, you're risk averse. So you shouldn't be trading in cryptocurrencies. You shouldn't be trading in all this AMC and trying to open up your own account. But the realities are, access to the markets have never been so open. You can go and open up an account tomorrow, a Robinhood account, and not pay not one fee to buy a stock, sell a stock. The transaction costs have pretty much disappeared. And so now what you had was, you have all these people that got their check-free money from the government. They're trying to put it in the markets, and the problem is they're losing their money. Okay, I'm telling you, right? You got the Reddit users, you got the army of Reddit, you got these people that are pushing stocks up. GameStop went from $20 to $450 in a week. Okay, so people look at that and they think, and they get FOMO, and they say, well, how come I'm not doing it? Mm-hmm. But I think it was Mel that said it before, if you're trying to chase, that dream, you're trying to chase money, you're 99% of the time, you're going to lose. And I'm telling you, all these people on social media are not making money. So coming back around, what we always recommend is understanding risk, taking control of your financial future, right? For those that are looking to create those separate lines. But for the majority of people, I just tell them, look, go get a financial planner and, drop your money in it and do your thing. But if you're looking to create those additional lines of income and you really want to expand upon that, we can show you how, you can really, we had, again, we're not financial advisors, but we had our money out March of last year. Okay. We hedge. Right? We show people how to, high net worth people, how to do that. So again, it's all about just if you want to try the market, open an account, but just make sure if you invest yourself, you're investing with money that you can lose. Mm-hmm. Okay. that you can lose on a consistent basis. Okay, now cryptocurrency, just talking about that, you got Bitcoin, altcoin, you got Dogecoin. You know, cryptocurrencies are not going away. Okay, they're not going away. And there's people, you know, there are some serious people making money. I mean, Dogecoin, which was put together as a meme, is up 12,000%.
Yeah.
Half a penny to 40 cents. Okay. Bitcoin, you know, Ethereum. The point is with the cryptocurrencies and stuff like that, you know, I always say, look, if you want to have fun, if you do want to put some money in that, make sure it's money that you can afford to lose every single penny, because it's kind of like back in the, I equate it to the tulip mania back in the 17th century. You know, it really is. It's a mania. But you know, can people make money in manias like that? Sure. Is cryptocurrency going to be here for a while? Absolutely. You now, and the way you kind of decipher some of that stuff is you look for the footprint of the institutions. Okay. You now have Square. You now have PayPal transacting in Bitcoin. You have all the institutions that are heavily invested in that. What's getting shaken out in cryptocurrency right now is regulation. Okay, because what's happening is, you know, the fiat system is, you know, they're trying to figure out how to merge all this stuff and still survive. So you're going to have, it's going to be very volatile. Yeah, you know, it's going to be volatile up, it's going to be volatile down. So again, you know, if you're in college and you want to play around with some of this stuff, go ahead. But just realize whatever you do, if you do open up an account yourself and you do decide to do something, do not go on leverage. Okay, and just you're investing money that you can lose. But you know, you can, you know, things have changed a lot, and you know, you can really, with some of the financial tools out there, you can really do well if you educate yourself making money.
Gotcha. That was very helpful. Thank you. I have one more question to ask before our ending question, then I open it for Q&A. Mike, I know that you mentioned index funds and things like that, and I'll open it not just to Mike, but to anyone else who wants to input as well. But how do things like mutual funds and exchange traded funds differ? And then what are the pros and cons of each?
Well, I mean, look, I know these other guys probably want to talk about this. So I always advise, look, you know, get an index fund, you know, mutual fund managers can't beat the S&P 500, so why try? You don't have high 12B1 fees. Make sure your 12B1 fees are low. Understand what the hidden fees are, and you know, typically transaction fees on index funds is very much lower.
I'm going to take that question, and I don't think it's an all or nothing proposition, meaning that I don't think, you know, one is good and one is bad. I think they both have places. Essentially, they're both pooled investment vehicles, and that's the big difference between kind of what we've been dancing around and what we've, you know, what we've been saying is I think most of the people on this call, especially if you're just starting out investing, you're going to use a pooled investment vehicle, whether it's a mutual fund or an ETF, or more likely a portfolio of mutual funds and or ETFs, versus trying to pick individual stocks. Yes, you can make money that way. You can also lose money that way. And so I think for the nest egg, for the core of what you're doing, and this is true for most of my clients, is I think you should be using these types of vehicles, whether they're mutual funds or ETFs, as the core of what you're doing. Now, if you want to take some satellite risks outside of that and make individual bets on some of the things that we've discussed here, by all means do it. But like Mike said, make sure it's money you can lose and you can afford to lose it all, because there's a much higher likelihood you're going to lose it than you're going to be one of these guys that hit it big in one of these companies. So that's my opinion. In terms of the differences between the two, you know, ETFs are generally baskets of stocks that trade on the exchanges throughout the day. Mutual funds don't trade; they just are redeemed once a day at the end of the day. So there's more. You have the ability to trade the ETFs more. Generally, ETFs are index funds, so there's no management. There's no one thinking about which securities should be bought and sold within that fund. It's just based on a broad-based index. Most of them. Mutual funds can be index funds, but generally they're more actively managed. So there's a manager or a team of managers that are trying to select what individual securities should be in that portfolio in an attempt to outperform whatever their benchmark is, and not everyone's benchmark is the S&P 500. And I think they're both good. Generally, you want to use index funds in the more efficient asset classes. So the asset classes where everything that you could possibly know is already known. So large cap stocks in the United States is a great example of that. Everyone knows everything there is to know about the Apples of the world. There's very little value that an actively managed fund or manager can add in that process. But go to the flip side, go to the world of municipal bonds. A lot of inefficiencies there, and a lot more opportunity for an active manager to create value, or emerging market stocks, go outside the US. So the less efficient the asset class, the more likely that an active approach is going to lead to outperformance. But they're both good, and I think they should make up the majority of what the most people on this call are doing for their investing at this point.
Got it. Thank you. And really quickly, Mel, did you have anything to add on that point?
I agree with a lot of what's been said. From my experience, most people are going to be using mutual funds to get their feet into investing, because what it does is it allows you to get using smaller dollars to get a piece of a portfolio that you own, rather than buying individual stocks. And that's usually a good starter to build upon. The vast majority of the workplace plans, like 401ks that have been mentioned before, are going to be using mutual funds. It makes it easier for people who don't think they have the means to buy individual shares of stocks to get involved in the markets and see the same returns and get instant diversification. So I'm a fan of mutual funds as a foundational investment for most investors.
Got it. Okay. And as we're coming to the end of our discussion, I'll ask my final question, which will be lightning round for everyone to answer. What is a lesson you have learned that you wish someone had told you about when you were first started investing? Then we'll go Mel, Mike, Denny.
Starting early, even if it's just in a small amount, and being consistent. And, it's amazing how time actually is probably the biggest factor in all.
Got it.
Completely agree. Start early, get a good mentor. They're the most, and don't listen to CNBC, please.
I've got 4. Don't make emotional investment decisions. Live within your means, save regularly, and don't invest using the rear view mirror as a guide.
Got it. Okay. Those are all great tips, especially that last one. It made me think a little bit.
Like you wouldn't drive a car using the rear view mirror. You shouldn't invest using the rear view mirror.
Yeah, definitely. That makes sense. Thank you all so much. So many thanks to Mel, Mike, and Denny for their insights and knowledge and tips on where and how to begin the investing journey. We'll now open it up for questions or comments from the audience. We'll start, of course, I asked the questions that we have, but if you have any questions, you can go ahead and send them directly to me or to Mark, and then we can ask those for you. Of course, you can always feel free to connect with everyone who's been on the panel this evening, as well as the rest of the Smith community, to tap into the financial advising and planning that you will be doing in the future. But if you do have any questions, please send them now. And if not, then we'll go ahead and start to close this evening's discussion.
I've got
ahead.
I've got 2 questions for you. Oh, sounds like my sound is, okay, there we go. So I have a quick one. Is it better to rent or buy when you're starting off with investing?
That's a good question. I am not, you'll hear, I'll say it this way. I know there's a mythology about home ownership in this country and its value. I believe you buy a home to live in. The one thing, and they'll always say, if you're wasting money on rent, you could be building equity. But what you get with a house when you're renting is you have a house over your head and you don't have the responsibilities of a homeowner, which can come in real handy when things start breaking. So, it depends on your situation. There is no right answer in this circumstance, but I do think renting does have its merits when compared to home ownership in certain circumstances. And if you're starting out, I think it's the cheapest way to go to start learning what you want as living arrangements going forward.
Yeah, I would piggyback on that. The answer to every single question that's going to be asked tonight is it depends, and it's very true, right? So it depends where you are in life. You can generally afford more of a mortgage payment than a rent payment because of the tax deductibility of the interest. So that's something to keep in mind. But I agree with Mel in that for a lot of my clients, especially the older clients who are, living in their last place, we're recommending renting only because it allows them to not have to worry about upkeep. It allows them to, they're not really building equity in anything. Their kids and their heirs are already going to get plenty, so they don't need to build equity in a home. And allows them to try out different places to live. If you're not sure whether you want to be in the middle of the country or on the coast or here, you can rent a place for several months or several years to get a sense of what it's like to live there before you put your flag down and commit to it. So I think it depends. There are some benefits to home ownership and building equity, but those aren't always important.
Got it. Mark, did you have the second question?
Yes. So this question comes from Shaba. What's the best route to invest during this continued pandemic with extra savings on hand? Savings rates are low, and I haven't had much luck with the stock market.
Give it more time. Yeah. It depends on your, I forget who the question was from, but I think it depends on your objectives, right? What are you trying to do with that money? Trying to build an emergency reserve fund? Because if that's the case, you shouldn't be taking any risk with the money. And unfortunately, savings rates are extremely low and probably going to stay there for the next several years. But that's the best thing you can do to keep the money safe and liquid should you need it. If you're saving for retirement, you should be looking at an employer retirement plan. If you don't have access to one, an IRA. And investing systematically into the market. The important thing is that you're getting exposure to the asset class in the market, not which individual stocks you're buying. That's going to make up the majority of your returns. And so that's what I would suggest doing, but it really depends on your time frame and your objective with the funds before you decide on how it should be invested.
Agreed.
All right. And then just to clarify, Denny, the website you mentioned earlier, was that plannersearch.org?
Correct.
Okay, got it.
It's sponsored by the Financial Planning Association, FPA. And you can go on there, type in your criteria, and they will connect you with multiple certified financial planners.
Perfect.
Got it. Well, we are at 7 o'clock EST, so that will conclude our session tonight. Thank you again, Mel, Mike, and Denny, for sharing such great information on financial planning and investing. Like I said, this will conclude our webinar. But as a reminder, our next webinar with the Young Alumni Council series is Real Estate Investing 201. And that'll be on Thursday, June 10th at 6 p.m. Eastern Time again. So don't forget to register. A link to tonight's webinar will also be shared and posted to the Alumni Relations website once it's finalized. Also, a list of additional resources from our speakers will be shared with all attendees. So again, thank you all so much for your time this evening. We hope that you gained some knowledge and some tips about financial planning and investing. And we hope that you all, including me, get a financial planner and figure that out for the upcoming years. But thank you so much for tuning in. And that will conclude our session tonight.